Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it, and basically we are discussing over the Banking Regulation Act 1949. And basically we are looking about the various provisions enumerated within the act. And since the last lecture or last to last lecture, we have started our conversation over the restriction over the business activities, like what are the provisions provided in the Banking Regulation Act 1949 to control the banks and do not allow them to participate in the regular business. All right. So basically, in this lecture, we are going to continue with the same topic, but we also looked upon the new topic called the penalties and offenses. Okay. Penalties and offenses also we will be looking at it. Okay, so let's start. But before this, let me remind you again and again, as I have always remind you, please revise the lecture before you come for next lecture. Why? It is your for own benefit. That's it. Okay, so let's start. This is we have completed. This is also we had completed. Now this is what we are going to do. Section 10. Section 10 specified that every bank must appoint one of its directors as the chairperson of its board of directors. All right. About board of directors, I had told you. Okay, this is the top policy making body of an organization. Body of an organization. Okay, and members are appointed by the election by shareholders during AGM, or we call it annual general meeting. Okay, so this is about the board of directors. It is a top policy-making body of an organization. Members are appointed by the election conducted by the shareholders during the AGM. All right. So remember it. Specified that every bank must appoint one of its directors as a chairperson of its board of directors. It also mandates that a minimum of 50% of the total number of board members of a bank should possess specialized knowledge or practical experience in fields such as accounting, agriculture, banking, economics, finance, regulation, and other relevant areas. All right. It means that first is the BOD, board of directors. Suppose if the 10 members or the 10 directors appointed by the shareholders during the AGM. So these directors altogether form the part of board of directors. But these 10 people have to appoint someone amongst themselves as a chairperson. All right. And this chairperson will be the chairperson of board of directors. Okay. And this is the main person who will communicate the decisions of BOD to the shareholders and the company as well. All right. Apart from this, it is mandatory that nearly or more than 50% of its members must be able to have a specialized knowledge or the practical experience in the fields like accounting, agricultural, banking, economics, finance, regulation, and other relevant areas with the banking. If it is not doing this, thereafter, the Reserve Bank of India maybe intervene in the selection process of the BOD. And why? Why the Reserve Bank of India will intervene? Because as per the section 10 of the BRA, it is mandatory to have a 50% members like this. And if it is not doing, it means that this is the violation. This is the violation of the section 10. Okay, so maybe the RBI will intervene or can take an action. All right. Thereafter, if we talk about the rationality, or we could say implication behind this provision, then what is the rationality or implication? The first is ensure qualified management. Second is risk management. Third is balanced decision making. And the fourth is alignment with industry standards. Okay, so these are the four rational implications. First is ensure qualified management. As I have told you, they are the top policy making authority. In an organization. So if in a case the top policy making authority is not capable or not having adequate knowledge, so it means that the ineffective and inefficient policies would be made. Okay, and eventually could lead down the bank towards their downside. It is the first case. Okay, second is risk management. If the board of directors are able to have the understanding of these areas, thereafter they could be easily useful for detecting the risk involved in the certain cases related to their field. Thereafter, the balanced decision making. If they all have a knowledge of their particular field, it means that there will be a adequate representation of various fields and proper discussion before policy formulation. Why? Because every member having a knowledge of their field and they are capable to give the directions. All right. And the third comes the alignment with the industry standards. It means that if they all are aware about all these things, it means that they are aware about the banking industry and they would be aware about the industry and its need. It means that they would be formulate a policy as per the alignment towards the industry. Okay, so that's what section 10 states. Okay, now if we move forward, all right, now let's move forward. Thereafter, we have a minimum capital provision. Okay, according to Section 11, subsection 2. Remember, it is Section 11, subsection 2 of the Banking Regulation Act 1949. No bank can commence or continue its business operation in India unless it possesses the minimum paid up capital and cash reserves as stipulated by the Reserve Bank of India. All right. So basically, this is the minimum capital requirement. It means that in India, there is a provision that if any banks wants to operate in the Indian economy or in the Indian banking sphere, if any of the bank wants to do such kind of things, it means that the particular bank has to maintain a minimum paid up capital and cash reserve in order to operate. Okay, so basically, if we talk about the minimum capital, then for private banks, what is the minimum capital that is required to allow them to operate? Okay, so in the case of private bank, at least rupees 500 billions must be invested as minimum paid up capital. Okay, it means that if these 3-4 friends wants to open a bank XYZ Private Limited, now by name you can say it is going to be the private bank. Okay, and we have covered that if someone wants to operate a private bank, they have to maintain a minimum paid up capital up to rupees 500 billions as per the latest guidelines of the Reserve Bank of India. So it means that 500 billions must be invested in order to start their business. Okay, even after rupees 500 billions is the minimum reserve should be maintained by the bank at any point of time. Okay, it means it is not only required to maintain the 500 billion investment as a minimum paid up capital during the commencement of business, but it is also required for continuation of the business. Okay, it means that at any point of time, if their reserve goes below rupees 500 billions, in such a cases, they are restricted to operate in the Indian economy or Indian banking sphere. Okay, so this is the criteria of the minimum capital. Thereafter, if we talk about the scheduled bank, then what are the scheduled banks? First thing is that banks which are mentioned in the second schedule of BRA Act 1949. They are under greater control of Reserve Bank of India. Okay, So scheduled banks are those banks which are mentioned in the second schedule of the BRA Act 1949, and they are under greater control of the Reserve Bank of India. Remember this thing? Okay. So if we talk about the minimum paid off capital for these banks, then it is rupees 5 lakhs. Okay. It means that with only rupees 5 lakhs, they could commence their business, and even they have to maintain rupees 5 lakhs as a reserve with with themselves as any point of time for the continuation of business. Okay, so this is the current requirements of minimum capital and other things. Even for the provisions of cash reserve ratios known as CRR for statutory liquidity ratio called SLR. Okay, even for these provisions, if the RBI states CRR should be 4% and SLR should be 6%. So each and every bank has to maintain their CRR and the SLR as per the standard. Failing to do so will attract a serious consequences as per the section 11 subsection 2 of BRA 1949. Okay, so remember these things also. Okay, now let's move forward. Thereafter, we have the section 13 of the BRA 1949. Now, section 13 is somewhat difficult to be understood, so I want you all to pay a clear cut attention over it. Okay. Section 13 of the Act restricts banks from making direct or indirect payments through commission, brokerage, discount, or compensation exceeding 2.5% of their paid up share capital when issuing shares. Okay. Now, what is the meaning of this thing? What do we understand by that thing? It's the important thing. Okay. So basically, first of all, in order to understand the thing, we must understand what do we mean by the PSR. Then we will come to this one, and then we will come to entire of this thing. Okay. So there are certain steps which we have to follow. The first is paid up share capital. What do we mean by this one? Okay. So it is the total amount fully paid by the shareholders to the company or bank against the shares listed or invited to people. Total amount fully paid by the shareholders to the company or the bank against the share listed or invited to the people. So let's understand the concept first. Suppose it is the bank called XYZ. Okay. The XYZ requires rupees 100 crores as a funding. Okay. So to arrange the 100 crores, they divided 100 crores into the parts of rupees 10 crores each. It means that there are total 10 parts, and these parts are also called as the shares. Okay, so they divided the entire capital into the small part or the shares, and thereafter these 10 shares would be listed in the money market. Okay, it means that if anyone who buy the part has to pay rupees 10 crores to the bank, and then he gain the partnership with the bank. Okay, as per the percentage. In such a case, every share contains the 10% partnership, right? So suppose if we had the 10 people, it's 6, 7, 8, 9 and 10. We had the 10 people who opted for the 10% partnership of the XYZ. It means that they each had to purchase the one share at rupees 10 crores. Combined together, total rupees 100 crores paid to the bank by these 3 people. Oh, sorry, these 10 people. Okay, this is called the paid up share capital. It means that it is the capital which was, or you can say, you can also go through this flow chart. It was a capital which breakdowns into the shares, thereafter listed in money market, thereafter bought by the shareholders, and then paid to the company or bank. This is the proper flow chart of the activities. Or for your better understanding, we could use different colors. Okay. Capital divided into shares, listed in the money market, bought by the shareholders, payment made to the company or the bank. Okay, this is called the PCS or paid up share capital. Sorry, PSC. Clear? Now, come back to the topic. It states that the banks are restricted to pay directly or indirectly payments as a commission, brokerage or discount or compensation which is exceeding 2.5% of their paid up share capital. Alright, now let's understand the thing. Okay, it comes the typical matter. Here comes the typical matter basically. This is XYZ, the bank. Okay, I am trying to make it very, very simpler. So please pay attention over it. Rupees 100 crores were the capital, divided into rupees 10 crores as one share, and as total shares were total shares were 10 shares. Okay, thereafter these 10 shares will be listed in the money market. Okay, to attract the people who could buy the shares of XYZ, they required a brokers, or you can say mediators, who will sell out these shares to the people and the money will be paid to the XYZ. Okay, but do you think that these people will work for you without anything? No, they will charge their commission or brokerage. Okay, so that they will promote our shares in the market and then they will attract the shareholders, or you can say the person who could buy these shares. All right, so here every calculation comes to this point: commission or brokerage. It means that whatever commission or brokerage promised to the brokers or mediators by the XYZ must not exceed the 2.5% of the paid up share capital. If we calculate the 2.5%, it will nearly comes our 2 crore 50 lakhs. It means that not more than 2 crore 50 lakhs could be granted directly or indirectly to the brokers or mediators as their brokerage commission or whatever. Okay, this is the criteria. That's what written it here. No payment directly or indirectly makes through as a commission, brokerage, discount or compensation exceeding 2.5% of the paid up capital. All right, now the question is why? What are the rationality and implications? What are the rationality or implications over it? Why the things is going to happen? This is the main question. Okay, so the first is controlling cost of share issuance and capital arrangement. Okay, it means that the cost which is bearing by the company or the bank, basically, like in payment of the brokers, in the marketing of the shares, this should be controlled. All right, if this is not being controlled, it will impact the financial health of the bank. Second is most important and little bit tricky. It is to protect the rights of shareholders by preventing heavy outflow of the capital. Okay, now we have to understand this point. How the rights of shareholders will be protected by preventing the heavy outflow of the capital? This is little bit tricky. Okay, so let's understand. Rupees 100 crores was the paid up capital, right? There's nothing wrong with it. Okay, and suppose 20% is the commission promised by the XYZ. Commission promised by the XYZ. Okay, so every shareholder who bought the shares has given rupees 10 crores. Okay, and if the 5%, or you can say if the 10% interest is promised to the shareholders on their stakes. It means that in case of 10 crores, 1 crore will be earned by each and every shareholders as a interest. But when 100 crores would be given to the XYZ, so that the 100 crores would be invested in the business, and thereafter the profit will be shared as 10% amongst the shareholders. You can say, so the shareholders has provided 10 crores. Then what is the problem? The problem is this. How? 100 crores should be given to the XYZ, but they had promised 20% commission over it. It means that the 20% of 100 crores is the 20 crores. So that 20 crores will be granted as a commission to the broker, and the remaining amount will only be rupees 80 crores. Okay, and if we divide it on the shareholders, it means that technically every shareholders invested only rupees 8 crores even after paying rupees 10 crores. Alright, and if we go with the 10% of 8 crores, then it was nearly about 80 lakhs. Alright, instead of 1 crore, how much every shareholder will get in return? 80 lakhs. There is no fault of these shareholders, but the XYZ had promised the excessive amount of the commission. It means there is a heavy outflow of capital, because the 20 crores would be granted as a commission and only 80 crores could be invested in the business. So does the profit would be count on 80 crores, not on the 100 crores. But the shareholders who had opted for the shares of the XYZ had paid 10 crores. But now they are getting the benefits of only 8 crores. This is the second implication. I hope you have got it. Okay. And the third one is very simpler to prevail. Transparency. Okay. So these are the implication on payments. Okay. Please revise this example again and again, because you will forget it if you can't revise it. Sorry, if you don't revise it. Okay. Now, let's move forward. Thereafter, the payment of dividend, section 15. In accordance with section 15, banks are prohibited from declaring any dividends on their shares until they have fully recovered all their capital expenses. It means that whatsoever investment made by them must be recovered. Then only they are allowed to maintain the dividends. Okay. Includes preliminary expenses, organizational costs, share selling commission, brokerage, any losses incurred, and other expenses not covered by the tangible assets. Alright. So students, basically in this lecture, we had finished the restrictions provisions. Alright. In the next lecture, we will go through the penalty provisions. Till then, just revise the facts and figures we have discussed in this lecture, because we have discussed them in thorough details. So if you haven't revised them and you will not revise them, let me tell you one thing very clearly, you will not be able to grasp the good marks in the examination. That's my warning, and that's the session I'm giving to you. Okay. So with this note, let's end this lecture, and thank you.